Hi, everyone. It's John. It's 9 a.m. Pacific time that I'm recording this. It's 12 noon Eastern. I don't have my quality microphone, so please bear with me and excuse the general quality of the audio. So, again, I'm an amateur individual growth stock investor, not affiliated with Market Smith or IBD. Here's the agenda today. I'm going to touch upon the indexes and the internals a little bit, and we're going to be monitoring for a change of trend, and we'll go over the big eight, then a summary, and then we're going to talk about the BlueSky6 speakers. So let's look at some internals and look at the indices. This was a week ago. This is the NASDAQ 100. Our biggest concern was we had this rally attempt and a follow-through day, and the rally appeared kind of weak and thin. So here's where we are today. This is actually cut as of last night, September 7th. So we had the follow-through day. Now, we were a little bit concerned about not seeing the net new highs, new lows improve. We still have net new lows actually increasing. So that's not a good sign at all. We also have drawn this dotted blue line here. This is an undercut that we had yesterday of the follow-through day. That's not a good sign also that the rally is going to maintain itself. Now, the rally is, quote, still alive until we've undercut the rally low, which I've shown that rally low started back here. So the rally's still alive, though it's kind of floundering a bit. Now, some people have looked at the chart of the Qs and said, well, this is a head and shoulders top. I guess that's a valid interpretation. We did push higher here. Usually the weaker head and shoulders have the right shoulder lower than the left. Another interpretation would be this is a cup with handle base forming in the index. Either one is valid to look at. We should be very, very flexible at this stage in the market. So let's move to the S&P 500. Chart was cut yesterday, last night. Again, we've had a rally. You've noticed over the past month, we've had distribution days that have been peppering the indexes. Yesterday, the index gapped down, but it tried to make a stand. We actually got some support to try and hold in there. Now, the net lows are increasing. That is not what we want to see. It's actually increasing more than we had in August, so that's a concern. And the up-down volume is barely at 1.0, showing we really don't have strong accumulation even in the S&P. So it's definitely possible we come down and retest this low from the middle of August. A deeper correction would be, the next basic area of support might be in this 4,200 range, which would be about a 9% correction in the S&P. So we'll have to take it day by day. Again, this is looking at the new highs and new lows. Probably our biggest concern was on the right. This is the NASDAQ new highs and new lows. We had no traction on this rally, very weak attempt. You can see there were no net new highs. And then what's happened this week after Labor Day, we've just started to see net new lows picking up again, which is not a good sign. Now we noted September. Here's a seasonal chart for the year looking at the last pre-election years, 10 years, 20 years, etc. September generally is not a good month. But if we were to blow up September, as Carson Research did, you can see that in the last 70 years, the first half of September is fairly positive. The second half of September has proved to be more problematic. And just to remind everybody, we have the Fed meeting on September 20th, right in this yellow window. So seasonality is really not in our favor, but anything can happen here, so we don't want to be inflexible. Now, monitoring the change of trend. We started to look at this last week. Let's see where we are. So we talked about we needed a follow-through day. Yes, we got a follow-through day, day 8. But the undercut this past week is a caution sign that maybe this rally is not going to pan out. Do we have proper bases with breakouts and setups? I would say no. Many bases are too short to be proper. They need to be at least 5 weeks for a flat base, cup with handles, 7 weeks. So many are still in the process of forming the bases. Net new highs. No, we just discussed it at length. We have net new lows. That's not a good sign. Do we have 3 consecutive days above the 20-day? No, we've actually broken below the 20 EMA. Breadth was fairly encouraging last week. We had 3 better breadth days. But this week, the breadth has been poor on multiple days. Volume, I would say it's really not that impressive, particularly individual charts still are showing higher red volume days than we are getting. We're getting these low blue volume days. So that's a concern. And I think we have to be aware that the Fed is looking at data points. Now, uh, they're showing some mixed information about inflation possibly rearing its head again. It's not coming down steadily across the board yet. Yet the CME odds show that there's a 93% chance that the Fed's going to pause in September 20th. So the market is pricing that in as almost a certainty. We'll talk about that later, but I think these data points are pretty important over the next couple of weeks. So let's look at the big eight. We started this last week, and we refresh ourselves. The big eight, here they are. And the reason we're looking at them is because they're so important across all the indices on the upside and the downside. They just have such a weighting that any rally concerning these indices and ETFs really has to have the big eight perform. So let's break down some concerns. I've sent some tweets out this week that I was concerned about the big eight. So let's break down some charts. So the first concept, we have Tesla here on the left. And the concept is the closing price on high volume days, which I call the HVC, the high volume close, that represents institutional activity. And we need to pay attention to those. And those areas can act as support or they can act as resistance in the charts. So we go over the high volume close a lot in the gap workshop program. But for this point, just be aware that these are important levels. So if we look at the Tesla chart, you can see here that way back over here in the chart, we had one of our highest volume days in the chart, and we had a close. It was a down day. So if I draw a line marking that level, it's about 259.46 in the chart. And that's an important level. Now, Tesla has rallied back up, and you can see that it's run into resistance at the 50-day moving average in red and the high volume close. Now, it's also getting support underneath it at the 65-day moving average. So it's kind of sandwiched between the two. And frankly, this could go either way. We don't know if Tesla will push through this and come up the right side of its base, or does it need to come back down and actually properly form a longer base? Maybe it's a double bottom, maybe it's a cup. We don't know, but it's really could go either way. Now, Microsoft has a high volume close. When it came off the top, had a couple of high volume days. So I've drawn that line in the chart. Microsoft has been the weaker big eight name. It's actually run into resistance at the 50-day, but today it's trying to poke its way through here about midday. Above it, though, is the high volume close that could act as further resistance, but it's forming a base. So Microsoft is also one to watch. Let's go over the one that's probably on most people's mind, NVIDIA. Now, we've been talking for months now about the psychological 500 price level in NVIDIA acting as resistance. And you can see here, this is the earnings day where it tried to get above it, resistance there. It's had resistance 2-3 times again. So there's clearly resistance at the 500 psychological number. But other key levels in the chart, the earnings day was a high volume close, really, really high volume. You can see it's a down day. So at 471.57 is a high volume close that could act as support or resistance. You can see we broke that as a support line yesterday. And you can see NVIDIA came down to the 50-day where it's still getting some support, kind of indecisive today. But we can look at the 50-day as support if it comes down. We have the 65-day as support, possibly if it comes down. And then I've also noted, we know that the 1 trillion valuation is right in the 409, 410 range. That also could act as support for NVIDIA. The point being, and I've been saying this for a couple of weeks, NVIDIA really needs to form a base. It needs to form a properly length base to really set up again to push through and launch through the 500 area. So this is one of the big leaders, so we want to keep monitoring its action. Here's Apple, another very important component of many of the indexes. So Apple had a very high volume close down just after its earnings, and we look at that closing price and we draw our line at the HVC is at 181.92. And you can see here, Apple actually pushed up through the 50-day, but quickly within a couple of days got rejected on a very high volume close as well. So we have a high volume close um, also that occurred a couple days later. It was on yesterday. So we have that high volume close in the chart too. So we've got Apple currently trying to get some rally into the gap today, but we're basically sandwiched between two high volume closes. We might get support at the lower one. We might get resistance at the upper one. Um, Apple has been plagued at the 3 trillion level, which is up way up here at 194, where it got rejected, couldn't hold it. So again, Apple's in a little bit of trouble here. We'll have to see what happens between these two high volume closes. But it's not a great chart in terms of the volatility and the gaps with the side of this. It's not a smooth base like we were seeing in Microsoft. So the other big eight notes that I made without the charts, Netflix is forming a double bottom base, finding support at its high volume close, which is 437.32. Google is probably one of the stronger of the big eight names. It continues to slowly move its way and grind higher. Amazon's forming a base. It's gotten support off the 50-day, but it also has a high volume close in its chart worth noting. And Meta is forming a base. It's had some resistant areas in the chart at the 50-day, roughly the 300 level, which is a round number, and a high volume close of 309.4. So you should look at those charts. Given the entire picture of the eight, that's why I've been cautious. I refer to the big eight kind of as vulnerable here, but we'll see if they can improve their charts. But at the moment, I'm kind of negative on the group, which means I'm a little bit negative on the ability for the indexes to push higher, and we probably need more time to form proper launching pads. So a quick review of the watch list that we started last week. We looked at some charts. We want to be looking at those stocks that have not corrected much and are pushing to all-time highs. They are showing very, very strong relative strength. CellH has been acting really well, VRT, APP, and a number of names here. If you go to their charts, they're really acting very, very strong despite a very mixed market. Now, there are some bases that are starting to look constructive and starting to reach length that is proper. Uber has a nice looking cup with handle that's forming, Duolingo, a double bottom. These are some other charts that you should dig into that I think we need to keep an eye on to see how these bases shape up. I do believe that NVIDIA really needs a base to reset. Oil and gas continues to be an area of strength in the market. Oil prices are going up, and a number of the oil equipment, oil suppliers are doing very, very well, particularly offshore. GDW is an offshore drilling company. So if you're looking for some of the stronger areas, oil and gas have been acting strong. So let's get into a wrap up and a summary of what this video is all about. Again, not a convincing rally so far to me. I think the big eight are vulnerable. They have a lot of resistant points in their chart, as I've described in the video. Net new lows are a negative sign. I can't see the market making a huge rally with these remaining as net new lows. It just doesn't really happen historically. Very little to buy from proper bases. I really mean that carefully. Make sure you are evaluating a base properly. Eyeballing a base and thinking it looks like a cup with handle or a cup is not good enough. You need to really understand if it's under accumulation or distribution. You need to make sure it's proper length and has the proper dimensions to see if it's really, really a strong base. Now, the positioning in the market, as I mentioned, with 93% of the market basically pricing in a Fed pause, there's a lot of positioning here. Now, the data has been showing inflation is flaring up, oil is rising. And, if the Fed were to change its position and get data in the next 2 weeks that shows that the data points are showing inflation flaring up and they actually raise rates in September, it could create a real shock to the market as people are positioned differently. Now, the Fed didn't see inflation coming in 2021. What makes you think they're going to see it reemerging here in the fall? The September pause by the Fed could be a mistake, and in November they're going to have to repair and correct that mistake. Potentially, if they have to come back and make up for that raise in November, that could really screw up the seasonality of the market being in a very strong period between November and January, where we typically get a year-end rally. That might be messed up depending on how that Fed handles September relative to the data. So I just mentioned that this is really, the market is positioned one way. If it goes the other, it could be creating volatility. But things can change rapidly. We got to stay really open-minded here. It's not clear where the market's going yet. I still think exposure levels should be pretty defensive here, maybe 0 to 20% is what my instinct says. And I will let you know that I'm actually short an individual stock name at this point. It's a quote of the week. In this game, the market has to keep pitching, but you don't have to swing. You can stay in there with the bat on your shoulder for 6 months until you get the fat pitch. This is with Warren Buffett. So just because the market is chopping around here doesn't mean you need to be, really pushing it in terms of exposure levels. We want to make sure the odds are in our favor and we get a good setup. So consider that. Now I wanted to come back to the BlueSky6 event, which is November 4th, save the date, and I want to share with you the speakers. We will have with us David and Sean Ryan, his son. So we have kind of real strong U.S. investing championships and pedigree here. They're going to do a really interesting talk. We're going to talk about the differences between the two and some of the generational lessons that David has shared with Sean, how Sean has incorporated those. We're really excited to have them together. John Boyk will also be with us. He's an author of multiple books on the stock market. His most recent one, Monster Stock Lessons, about the 2020 bull market. We're going to get into some really interesting things about how John has incorporated these lessons that he's learned from traders into his process. Andrew Rocco will be with us, formerly with IBD MarketSmith. He's now with Zacks Investment Research. Andrew, we're going to focus on artificial intelligence. We're going to look at a comparison of the internet build out in the 1990s and how it could play out with artificial intelligence over the next 3, 5, and 10 years. And we'll talk about individual stocks that may be beneficiaries that we should keep our eyes open to. Gil Morales will be with us. Gil was a market strategist with O'Neill for a number of years. He now has his new website, theowltrader.com, and he's also the author of multiple very good books on the market. So you can check out those books, and he'll be joining us as well for BlueSky6. And Kenny Polcari. He's with Case Capital Advisors. He's a former New York Stock Exchange floor trader. We're going to ask Kenny some topics around artificial intelligence, what's positive about artificial intelligence in the markets, and what might be some of the cautionary signs of artificial intelligence in the market. And then we're going to look at some really interesting market stories that he can tell us from the floor. Got some interesting things planned in that conversation. And I will also be doing a presentation. I'm the founder of the Blue Sky. My presentation this year will be entitled as The Irrational Behavior of Rational People. I'll be talking all about different biases that traders have in the market that we need to be aware of, and some tips on how to cope with those biases as we're making decisions. It's going to be a great event, and I'm going to put out a video. I'll put out a 5-minute video that we have a couple special early registration specials coming up, so that'll be in the video, and we won't open up our registration till probably later in September, but I wanted you to see the quality of the event and the speakers. So that's the general market update for September 8th, 2023. Have a great weekend, and we'll see you next week, the next update.